Good evening, everybody. How are you all? Welcome to this presentation tonight. My name's Campbell Venning, and I'm going to be your host for the evening. Okay, history. Who are we? Property Factory. Property Factory was a concept that I had about 7 years ago. And the concept came from the problem that I got frustrated with in the very ongoing balance of supply and demand of properties that I was experiencing as a property person. And what I mean there is, as a property professional, I've been doing property now for I worked it out today, it's 28 years. Bought my first property 28 years ago, and I'm 50. So you can do the math, how old I was when I bought my first one. It was 22. And that was in Wellington. And it was our first home, but unbeknown to me, it became my first home investment. And what that meant was the property was our first investment, even though it was our home. And I'll get to that later on. But as I went through my first my first chapter in my property career, I didn't have a plan. I didn't read a lot of books. I didn't go to events and seminars because they didn't exist. We ended up buying a house that was 3 flats. And for the next 10 years, we bought the worst house in the best street, renovated them, took them from student accommodation to executive accommodation. And from there, we developed a pretty sizable portfolio in Wellington. I never sold anything for the first 10 years. That was my first chapter. Second chapter, I got into property as a business. I became self-employed in property. And during that chapter, I became a property trader. I became a developer. I organized syndicates of purchases into multiple properties. And right now, if I fast forward to 2019, I've had the last 2.5 years. I tell people I've had the time off, but I have built and sold, or built and kept, over 40 properties in the last 2.5 years. So I've had my head down and bum up doing my own thing. I'm over that. I'm bored. I now want to engage again with customers. And the Property Factory, even though I launched it about 6 years ago, it's been asleep for about 2.5 years. And where it came from was I did a quasi MBA at Auckland University as a relatively seasoned investor. I was the first property customer that I'd actually taken through this course. It was a 6-month MBA course for small business. And all of the other companies that I did it with, and there were 25 of us, 26 including me, but 25 other companies, we all came to basically put a thesis/business plan together for our business. And at the time, the founder of Icehouse, which is run out of Auckland University, John Irving, John Irving. He founded it, and his claim to fame was that he was the CEO for Watties when it was sold to a conglomerate from the Northern Hemisphere. He looked at our business plan that I put together and said, hey, that's pretty impressive. And basically the business plan that I put together then is now coming to fruition today. And when I say today, I've probably spent $500,000 putting this business together to solve what I deem a growing problem. And that growing problem is helping tenants into accommodation, helping landlords get into being landlords, helping first home buyers get on the property ladder. And as the father of 3 kids, one of whom's 17, I'm convinced that if people like me and my colleagues in the Property Factory don't help customers, we've got a bigger housing problem than we've got today. And we, according to Labor, need 50,000 houses right now. Now, I think the problem's bigger than that. If I look at the second-hand stock in New Zealand where tenants are living, I think we should be ashamed as Kiwis. There is a real big gap between acceptable accommodation in the eyes of the tenant and acceptable accommodation in the eyes of the landlord. And I have pivoted my business model now that the only property I will sell to landlords is brand new, because our second-hand housing stock is pretty bad in New Zealand. And from a health and safety, from a New Zealand health system perspective, there are a lot of landlords out there that haven't been spending money on property, and it's costing us as a country. And I want to do my bit to prevent that from carrying on. And if you go and look at rental properties in Rotorua, Wanganui, Invercargill, Dunedin, the secondhand stock in those locations is, in my opinion, third world. It's terrible. We should be ashamed. And in some locations, and one of those happens to be the property that we're going to promote tonight, it's actually cheaper to buy new than secondhand, which is just crazy. But the reality is Kiwis love secondhand property, and Kiwis love renovating, and Kiwis love getting a deal. But what a lot of people forget when they buy a secondhand property is the cost of running it, the cost of maintaining it, the cost of keeping it compliant. And good on Labor, they have bought in a lot of them, and the National was going to do it if they'd got on. They've bought in a lot of new compliance costs on landlords. And to give you a snapshot of where this could end up, and I could speak about this topic for 2 hours because I'm passionate about it. If you go to places like Hong Kong, Singapore, New York, it's very rare for private landlords to own property that's new. Because what happens now in those countries, the government or the public sector have said, you know what, we're not looking after our tenants. So what they do, they get public companies or super funds to buy pieces of land, build apartment complexes, and rent them out. They don't sell them to individual investors. They don't sell them to individual landlords. They run them properly and professionally. And if I look at New Zealand, we're way behind the 8 ball here. You know, developers typically, without putting the sword into them, all they really care about is profit. They don't think about the sustainability of the building. They don't, even though they've got guarantees on it for 10 years, they don't look at the quality of life for the occupants. And I'm being harsh here, but the reality is developers are driven by profit, not social acceptability or social standards. So I look at that as an investment specialist, as a property investor, a property trader, and a property developer, that unless someone starts a movement to right that wrong, in 10 years' time, our secondhand housing stock will be 10 years older. People will be living in even more squalor than they have been. And as a country, it'll hit the medical system, it'll hit the health system, it'll hit the education system. The gap between rich and poor just gets wider. And I might sound like a screaming left-wing socialist, but the reality is, in New Zealand, the cost of that falls back on the state. So being a private sector centre-right believer, at the moment we're getting forced down that centre-left line because of the gap between rich and poor. And I believe everybody right now in New Zealand, especially first-home buyers, can buy property. If they set their mind to it. We still have very cheap locations. We have unbelievably good rules to buy property in terms of debt, cost, rules around tax breaks when you're an investor. So there's no reason we don't have 50,000 more people a year owning their own homes. It's crazy. So I'm going to do my bit in my next 10 years to help bridge that gap. So that's a boring history of the property factory, but the reality is the property factory has been set up as a supplier of cheap property. When I say cheap, discounted property that's new, that suits two primary markets, property investors and first home buyers. And this isn't my first rodeo. I've transacted in over 2,000 properties in my career. And I've just bought a new home, and I've bought an old house, but I bought it knowing that it's been well renovated. So, you know, I see it from both ends. Even though I won't sell secondhand property, I'm talking about that from an investment housing stock because I look at it and most of it's rubbish. It should be bowled and redeveloped. And there are some brilliant developers who are in my world who are bowling old houses and building townhouses and flats and apartments, and that's great. So the property factory only sells new stock or property that's been built within a few years that's sitting that we can move for developers and builders. So we're a wholesale listing agency. And what that means is that we will only list property that suits first-time buyers, property investors alike. Well, here we go. I didn't need to tell that. So 2,100 properties we've done over the last 24 years, nearly $1 billion worth. And if I look at our expanded team or our wider team across New Zealand, we are trying to facilitate builders meeting customers, developers meeting buyers. And whether that's an investor or a first-time buyer, it doesn't matter. If I look at builders who go down the show home unit and they hire sales teams, I think they're signing themselves up for failure. Developers and builders are good at developing and building. Sales and marketing companies are good at sales and marketing. And if you try and be both, you're splitting your focus and it doesn't work. So we are very clear about what we do. We find great properties and we match them to purchasers. Okay, so we are a listing agency. We are a finding agency. We are a property sourcing company. And we've got a direct sales model, which is like buying through the manufacturer direct or the wholesaler direct. And our third-party sales model, we provide real estate agents, real estate companies with the same properties so they can sell them to their customers. So, yeah, like I said, we've spent a lot of money on this business over the last while, and we're excited about launching it over the last couple of weeks. So that's a bit of history about what we do and what I do. A little bit of background. This is on our website, so I won't talk for too long. I'm not really good at beating my chest and saying I'm really good at this or really good at that. I just do what I do. I'm totally passionate about property. I could eat, breathe, and sleep it 7 days a week, and sometimes I do, and it does my wife's head in. In fact, my son came to an event last night we did in Christchurch, and it's the first time he's really got his head around what dad does, and he's 17. And he was like, "Hey, when can I buy a property, Dad?" And the reality is he's got his first job, and he can start now. He's got an income. He can get KiwiSaver. He can start saving. And a lot of friends, kids 19, 20, 21 have focused on that, and they've got money to buy a house. And if I can help them, that'll be amazing. If I can help people that are close to me on a family front as well as customers. So we break property down into a strategy. I look at every single real estate, apart from your emotional home, and even then it's still an investment to some extent, but there's an emotional component which is hard to get around. But rental property, investment property, whether commercial or residential, as far as I'm concerned, is nothing but a commodity. It's an annuity. It's a money box. It's a cash machine that spits money out to you. And depending on where it is and what it is will dictate what kind of return you get. Do you get a whole lot of money out at the front, or do you get a nice slow payment over time? So money in real estate in my world is as black and white as putting money in the bank or money into government stock or money into real estate to get a return. Typically, the higher return comes with a bit more risk. The longer safe return over time comes with lower risk, and that's where we start people off that are new to the industry. I've got a client at the moment who's got about 12 million bucks worth of real estate. His file's on my desk. And I'm going to give him a three-pronged strategy that's relatively complicated because he's got a lot of real estate. He's moving into another stage of his property career. And we're probably going to make some recommendations that might make him think about it for a couple of weeks before he actions anything, because they're quite dramatic. But when you've got that kind of money tied up in real estate, you've got a lot of choice. He could get right out of residential into commercial, which we're not going to recommend, but he could. He could put it all in the bank and live very happily off a very low bank interest rate. And he probably won't do that. So he's got so much choice. We've got to be quite focused with our recommendations to him because, you know, he wants to make some changes. Whereas another client is going to buy their first home. So the choice then is where and what price and what kind of property. So we break up property into categories. You know, the one on the top left of your screen, we did a bulk discount on mass or volume stock acquisition and sale. Clients in that project, that was a long time ago, got a 37% return. More recently in Wanaka, North Lake, our clients were buying house and land packages off us for the early sixes, late fives initially, and they were valuing up at over 700,000 on completion. So that's an early stage prime land subdivision. Christchurch and St Martin's Green, Waltham, our customers got a 27% return. That's capital return, not cash, when they bought off the plan in a project that was brand new. That render that you're seeing there is now a real product with tenants in it. And those properties are returning over 7% on cost, or what those people paid. Maybe more than that now, maybe 7.5%, nearly 8%. Bottom left, it was a short stay property that we set up in Queenstown. That was an unbelievably good return because of the market timing. But 87% return on capital employed in two years. And then we ended up selling it for nearly 100% return on capital on disposal. It just got to the point that it was too good a deal not to sell, because we can go and build, we're building 3 more of those at the moment. Early stage prime house and land package in Bridesdale, Queenstown. We had 12 customers that benefited from that subdivision. We ended up doing one ourselves, and we ended up selling it because the capital return was so high. We decided to take the capital return versus the cash return. And again, these are phrases or terms that you should start to understand. Cash return is very different to capital return, and no one's ever been told off for banking a profit. So we are, as I said, I'm an investor and a trader, and we decided when we entered into that project, we were going to be the investor and keep all of the property that we put our foot on. We in the end decided to sell 4 and keep 1, and then when we got to completion, we looked at it and thought, no, we're not going to keep it. It's too good a property for an owner-occupier, and we sold it to a owner-occupier, not an investor. It was too high a return on the capital front to make sense from a long-term cash flow perspective for an investor. So the best use for it was a home, and we sold that to an owner-occupier who lives in it now. And 11 of the other customers I bought into that subdivision, some sold, some kept. So again, it's horses for courses based on your financial circumstances. And new apartments in a rising market. So these are just a couple of different property deals that we've done. You can jump on our website. We haven't actually put them all up. We put some of them. But I guess the track record that we've got is pretty impressive. 2,000 odd properties, nearly $1 billion over the last 24 years. And if anything, we're accelerating further than slowing down. A couple of years off has been good to re-energize the batteries. So just checking if we've got any questions. No? If you have got any questions, throw them into the Q&A box. I'll stop sometimes and look at them. But we're going to have a Q&A session at the end. So feel free to just chuck them down as you go. And in the meantime, hopefully you're still with me. So one of the things I'm really big on is educating or helping clients understand why some properties are not equal to others. Why? Because I get the most common question I get is, what's the best property? I mean, that's like saying, how long is a bit of string? It's so crazy. But I guess Kiwis, they like a deal. Kiwis like a bargain. I'm no different. I mean, I've imported the last 2 cars that I own from London because it was better than the deal I could get from the local car dealer. So we're all the same in New Zealand. You know, we like to get a deal. So when people ask me that question, I know exactly what they're talking about. They think, oh, well, give me a deal, Venning, give me a deal. Well, deals start in the right location, and then they stay in the right location, and they end in the right location. And that's the old saying, location, location, location. Because every deal is different, and every deal is different for different people, because not all investors are created equal. They're different age, they've got different income, they've got different equity, and I'm going to talk about this stuff later. But the point is, a deal that's perfect for Mary could be an absolute disaster for Marilyn. But if I look at core fundamentals, there are some things which you don't ignore. Location's obviously number one. Infrastructure plans in the location is so key to your early stage capital growth and cash flow in some instances, that it's probably more important than the product. It's probably more important than the developer. But the infrastructure forecast or the infrastructure plan for that location, and if you know what's going on, you can almost predict where your property is going to go. And if I look at North Lake Wanaka, when I first bought into that project, and it's a land subdivision in Wanaka, 12 to 1,500 sections. It's 2.5 years ahead of its original sales plan. I was the first customer to buy sections in there. I was the first customer to live in a house in there. When I say live, I rented the developer's show unit. So I can and I was the first person to use a tennis court, which they're now moving. But I am an eternal optimist. And when I looked at that subdivision, the developer said, you can have 10 sections at this price, up to 10. And I took all 10. And then I bought another 10, and then I bought another 10. But in that initial 10, the very first 10 that I did, I paid $202,500 for those sections. I expected those sections to go up to 230, maybe 240, if it was crazy, 250. And the sections that I ended up buying are now trading 320, 330. And the highest price one that I sold was 285 or 280 off memory. So I got it horribly wrong the right way, in that I underestimated how good that subdivision actually was from an investment perspective. So that was a nice failure, if we want to call it a failure. But the infrastructure, the reason I knew it was going to be a winner was the infrastructure money that developer was spending on the location. He created a brand new suburb. I mean, it's got a medical centre, it's got a childcare centre, it's got a pub, it's got a tennis court that's being moved. They're putting a hotel in there. It's got a commercial office precinct. It's a whole new suburb. North Lake is now a suburb. So when that happens, and it happens all over the country, you're pretty much guaranteed capital growth. I mean, no one will put that in writing, but it's pretty common, not even common sense. It's pretty assured that when the government or a private developer spends that much money in the ground and people buy land and build houses and businesses come there, eventually capital growth flows. Sometimes faster than others. You know, if a developer launches too many sections in an area with low population growth, it doesn't always work. So we are very careful to pick the right location, compiled with the right infrastructure planning that's going on. So once we've done that, then we start thinking about developers. A lot of investors, especially green investors, get sucked into the deal of the year that looks pretty and it's got a gorgeous brochure and a beautiful render and it's got the most amazing 3D images. But the reality is the developer probably hasn't got 500,000 to his name. And this is a hope and a prayer that once they get sales, they're going to make some money. We look at the developer's track record. What have they done before? And we've had some argy-bargy this week with a developer that's desperate for us to sell their property. And I keep going back to them. What have you built? Show me a previous product. And it's going to get it goes into the silent void. Their track record is as important as my track record. I will not back a horse that's not proven. So then we look at the area. We look at the wider area. So in North Lake Wanaka, that's Central Otago. That's Wanaka. That's Wanaka broken down. And then we look at each suburb, we break them down and we look at their financials. We look at their metrics from a population growth, from a sale value perspective, from an average sale perspective. We rip the scabs off every statistical, historical number we can get. And then we throw it into a great big blender. And if it spits out that it looks very assured that North Lake or Timbuktu is going to be a good location, we then put our name on it. And in the situation with North Lake, that was the land. At that point, we then worked with one builder in that instance to get the right product, the right design, the right quality. I mean, when you're building property for investors, you put a very different specification and fit out in the house or apartment or townhouse than you do if you're selling to owner occupiers. First home buyers need a very different fit out and specification to someone that's going to be there for 7 years. The average first home buyer lives in a house for less than 2 years. So we always look at who the end user is. And if there are any first home buyers on this webinar, you aren't first home buyers, you're first home investors. And when you get your head around that thought, you actually look very differently at the property from a what you want perspective. The amount of people that I send expectations screaming through the floor because he or she typically wants the nicest kitchen and the highest spec fit out, but it's like cars. No one gets money back for TVs and cars and cruise control and heads up display and radar assisted side view crashing. No one gets money back for that stuff. They're nice to have, but if you're going to only own the car for 6 months, 12 months or 2 years, why would you pay for it? And houses are no different. Granite bench tops, tiled bathrooms, plush carpet and expensive drapes and curtains and landscaping doesn't get any more rent. So if you're building a house for a tenant, you want to make it as bulletproof as possible because they're not as nice to the house as an owner occupier. But more importantly, your rent on cost, there's a return is higher the least amount you spend. Now, in 10 years' time, if you're going to sell it to an owner occupier, you might rip the kitchen out and start again and rip the bathrooms out and start again, but you've had them paid off over the last 10 years. So who's your target person at the end? Is it an owner occupier or a tenant? And that has a big impact on how we help first home buyers, investors, and serial or professional investors spec out a house. And we look at that at the lower level. So I'm now going to just get at the bigger picture of New Zealand. We know what we're doing. We've been doing this a long time. I've been through 4 property cycles and I am a serial investor. My biggest challenge with myself is every time I look at a property is deciding whether it's a keeper or a trade, because I love trading and I love long-term holds. At the moment, I've been doing a lot of trading around the country in terms of buying and selling. I had one settle this week in Christchurch that we had a $70,000 uplift in less than 12 months. And I'm just trading some stuff out in Central Otago at the moment. We've got an industrial subdivision in Karamu that's finished and completed. That's not a trade, that's a development. So I play in different pockets. Now, I'm not a first-time investor. I'm not a first-time trader. So I've been doing this for a long time. And when you're starting as a property investor, whether it be a first-time buyer or a first-time investor, you should go down a very, very low-risk and structured path. And it's not hard. It's scary, but it's not hard. And you will help solve New Zealand's housing problem. And let's go further down the path. Healthcare problem by not burdening the state with your financial problems in the future. And what I mean there is property is usually a person's biggest asset. And if people buy their home and do nothing else, they typically live off that home until they die. And that sounds pretty morbid, but it's true. A lot of people get what's called a reverse mortgage and live off, they basically have a slow increasing mortgage over time until they die. If they get it right, there'll be some money left for the kids. If they don't, there'll be nothing. And if they get it wrong, they'll run out of cash before they die. Pretty morbid, but that's what happens. If you do property properly, and on average, we say a standard property investor needs to buy 5 properties in 5 years. And from that, on average numbers, they will be able to retire and live off the income that their properties generate. That is what I call property investing 101. It's the most basic and simple rule, but it's not that structured, because within a property market, you have what's called a property cycle. And Auckland's property cycle is at a very different stage to Wellington's, to Christchurch, to Wanaka, to Invercargill. New Zealand, by international standards, is pretty easy to predict if you know what you're doing and looking at. And we are also still one of the most aggressive tax treatment countries for property investors. Now, Labor have done a really good job on spoiling that little party, but to be fair on Labor, so did National. National have made some changes to the property sector over time, and the mooted changes that Labor are talking about making, some of which haven't come to fruition, some have. One of the biggest changes to property was done a number of years ago, and it was around a thing called depreciation. And property investors had this wonderful non-cash expense. The government allowed them to depreciate or expense 4% of the building every year, so that they maintained the property and looked after them. So what that means is, if the property was worth 500 grand, in a calendar year, you could get a $20,000 expense that was a paper expense on your property. And in the world of tax, that was the equivalent of about $6,500 cash back to you. And the government had this in place so that people would take that tax rebate and spend it on the property to keep the property maintained. But Kiwis being Kiwis and relatively tight and relatively miserish with their checkbooks, were taking that tax rebate and spending it on holidays and cars and boats and deposits for new property. Great. But the properties weren't getting looked after. So we live in a country where it's far more attractive to invest in property than it is in others. And even with the government taking that depreciation claim away, it's still very, very attractive by international standards. So, and it won't last. I can see in 20 years, the only people that can build investment property are funds and institutions and big corporations. I can see that happening in New Zealand. So if you're not on the property ladder, you need to get on pretty damn quickly, because at some point, even if you want to, you won't be able to. And that's the bit that saddens me as a 50-year-old Kiwi with kids and hopefully grandkids in years to come, who the choice may be taken away from them. So why property? First of all, because right now you can, and in the future you might not be able to. So let's just assume that you all believe me and you think property is a good vehicle. Then you've got to start looking at the macro picture, the helicopter view, the overriding what's going on in New Zealand. And I said before, we have markets within markets. Property cycles typically last between 7 and 10 years, but each city in a country is at very different times or points of the cycle, because in New Zealand, we have a really straightforward growth process. Auckland's our only true international city. And as a Cantabrian with my parochial hat on, doesn't matter what you think of the Crusaders, Auckland City is a much, much more powerful machine, and it sets the tone for our country than anywhere else. It is the major city in New Zealand. So I'm going to talk about Auckland in a minute, but if we look at New Zealand as an average, the left-hand side of the screen is the quarterly change in the national population. And if you look at the last 3 years on that graph, you know, the population change from a numbers perspective has been going up for a long time. Since 2012, we've had constant growth from a population perspective. And I've got some more stats on that in a minute. If I look at the slide on the right, it's saying that our average housing stock as of, I think it was last month, was 686,000. So that means that that's the average house price in New Zealand. If I look at the buyer types, and where this is relevant is who is buying and selling property, okay? And if you look at, there's a lot of graphs, there's a lot of lines on that graph, but the three to look at are that a mover, from someone from buying and selling, is declining at the moment, and there's 27% of the market. The multiple property owners is 24% of the market. That's a decent chunk. And back in 2006, it was 26%. So it's a slight drop. So less people are owning multiple properties with mortgages. If you look at the real interesting, well, not interesting, it's not interesting at all, but the market that's going to save our country is the red line. That's the first home buyer market. 2006, 21% of our sales were first home buyers. Now it's 24. That's good. And we've had some ups and downs, and that comes with interest rates and lending criteria and education. But right now it's heading on a nice steep path up. And that's what we want, because we want first home buyers to get into the market. I'm just going to back up that for a second, because in terms of markets within markets, we've got locations within the country and we've got buyers within locations. And the same sample of buyers will be pretty similar across the country, but those different buyers are affected by what's going on in that market. Investors are a far more educated group than first home buyers. First home buyers will buy where they live. That's what they want. They want to live in a house near where they live. Doesn't matter where the hell that is. It can be in Gore, it can be in Ashburton, it can be in Christchurch, it can be in Whakatane, it could be in Tekawara. It doesn't matter. And that group is growing, in my opinion, not fast enough, and we're going to do our bit to help that group grow. So let's assume you still listen to me and you believe that I think that or you like my strategy of what I say and how I look at property. I'm now going to look at really simple property strategy and extrapolate it or forecast it out. So let's say you listen to me and you go, yeah, Venning says 5 houses in 5 years or 5 properties in 5 years. We're going to hold the properties for 10 to 15 years, and we're going to go through 2 cycles in the future. So if we look at the past, that's a fair prediction of the future. We're not going to get Ferraris and go on holiday 3 times a year. We're actually going to pay the debt off, and we're going to live off rents in the future for the rest of our life. Now, I know a lot of people, including my father, who's 86. He's been living off rents now for nearly 20 years. He retired in Hong Kong as a judge. He plowed every bit of money he had left from living into real estate in New Zealand as a judge. And he's the closest, he's the closest investor I have. He's my dad. I find a lot of real estate for him. I still transact with him. So he's a business partner as well as my father. But he's been living a very, very good life off rental income for a very long time. So this stuff's real. It's not made up. I could stop right now working and live off property. It's a choice I could make, and I couldn't think of anything worse, because I'd get bored. I'd lose purpose. It would be depressing. Even the last 2.5 years have been pretty boring from a customer point of view, and I'm really looking forward to getting back into it. So let's just pretend you believe this story because it's real and other people have done it. If you just buy 5 average houses for 500K each, and you borrow $2 million, so that's relatively high gearing on entry at the start. So that means you're borrowing 80% of those properties, and you go through 2 market cycles. Your net result is $6 to $8 million worth of property in year 15. So that is, it's a long way away, but that's just you buying 5 houses in 5 years, getting standard capital growth rates, paying debt off. Because what happens with debt, you get to a point that it accelerates. You get it to a point where the rent is paying off far more debt in year 12 than it did in year 4. And then when it gets to year 15, it's really fast. It's paying it off really quickly. So by the time you stop working, you've got 100% of your rent or 80% of your rent to live off. So this is real stuff. This is what people do. And it's hard for people to get their head around it because it seems so far away, 10 to 15 years. But in the scheme of your lifetime, that's actually not all that long. I've got an 11, 13 and 15, what am I talking about? I've got a 13, 15 and 17-year-old. It seems like just the other day that we had them. So 10 years flies. And if you've bought houses and they've got capital growth and rent increases over time, this can be you. So that's a simple strategy. And just to give you some real life examples, these are some of the deals that I've done. So I bought 4 townhouses off a developer in Christchurch in one hit. I paid on average 320 grand for each. I gained 70 grand on valuation, and I actually sold these. So that's a 22% return. I sold them before I bought them. I sold them before they were built. So this is an aggressive trading strategy. This isn't, there's nothing guaranteed. When I signed up for all 4, I had to settle them off, and that was 15 months after I signed up for them. So I was taking a big risk at that point. But I was pretty confident I would have sold them, and I did. And I had a $70,000 gain per sale times 4. So that's a trading strategy. It's instant equity on settlement, because I'm buying for 320, I'm selling for 390 on the same day, even though I'd committed to it financially, 15 months prior. This is the type of thing we do. House and land in Wanaka. This is North Lake. This is North Lake about 6 months into the infrastructure. Oh, sorry. That's about 6 months in. It's a bare land subdivision. The houses you can see to the left of the bare land were there about 7 years ago. So all of that brown dirt was what people were looking at when they first came and saw this subdivision. And they were going, oh, I don't want to live here. It's a dust bowl, all this dust floating around. If you drive through North Lake now, you'll want to buy a house there. It's a great suburb. The bar's open. The tennis court's played on. The childcare centre's full. The commercial space has tenants in there. It's a beautiful subdivision. And I don't know how many houses there are. I haven't counted them up, but I was down there a couple of weeks ago looking at some of our clients' properties. And there are very, very happy tenants and owner-occupiers in that new suburb in Wanaka. As I said earlier, we got it horribly wrong. We underestimated how much those clients and ourselves were going to make in that subdivision. So this is, I would say that's a non-typical return. That was good timing and good judgment. But these deals come up all the time. You just don't know which one's going to be that time. And you have to make some, I guess, calculated decisions based on forecast expectations, and that's where we come in. We've got, in my opinion, pretty damn good judgment with 50 years across the team who can help you. Similar product to North Lake, but this was in Queenstown, a little bit less, but still very healthy returns based on the location. And this one, I sold this one. These are my numbers. We actually sold it for a bit more than that, but round about similar numbers. I think we sold it for 720. But on this one, we decided to sell early just to de-risk it, and the market went further past it. So I traded out a little bit early, but that happens, and I still made a nice profit. But I moved on and did it again. Wellington. This is an apartment complex in Wellington. This was the first dual key complex that we got involved in Wellington. And all of our clients did really well in this building as it was getting built. Queenstown, one-off deal. We bought it for 505 grand and we sold it for 785 grand in about 13 months, 14 months. So again, market timing was pretty predictable in my opinion. I could see what was going on in Queenstown. It was flat for so long. And my only frustration was I didn't have $1 billion to spend there, because it was so obvious what was going to happen with the tourism numbers going through the roof. So we have a heap of examples online that you can jump on our website and look at, but that's just a bit of a snapshot of what we've done. And, I guess track record speaks louder than words. These are real. You can check them out. You can look them up on QV. We're a licensed real estate agency, so we're not going to start making false representations. Would be crazy. And like I said, I'm not one to blow my own trumpet, but when I look back on the track record that I've had over the last, number of years, it's pretty good. So I've just got some questions here. Or maybe we pause as I look at these. Melvin's asking, do you think that investors over the age of 65 can make some gains in the property market? I always say to people, it's never too late to invest. At 65, your risk appetite is going to be much lower than someone at 25. And we would advise a client of that age to be really safe and steady. So it depends on your starting position, Melvin. It depends on your income. It depends on your assets. And once we know that, we will put you in the hands of the right advisors to make sure that the advice we give you is sound and long-term and safe. You know, it'll be basically a 30 to 40 year plan. So, you know, everyone has a starting position, whether you're 15 or 65. So it's not too late. There'll be some locations I'd definitely steer you away from, but there'll be other locations that I'd definitely steer you into. So hopefully that answers. And you've made another comment here, Melvin, that, you know, capital growth needs 5 to 8 years of time frame. Well, yes and no. If you're buying at a part of the cycle where you're getting and I did this in Queenstown. I mean, look at the deal that I just showed you. That's not made up. I did that in just over a year, $280,000 capital gain. Was I lucky? No, I made good judgment. That's not luck. So can you do it in less than 7 to 8 years? Yes, you can. Can I guarantee it? No. Can I give you good judgment? Absolutely. So, you know, have a look at our offer at the end of this presentation, Melvin, and, you know, it's a pretty cheap way to find out if we, you know, can help you from your current situation perspective, because we've worked out that the best way to help people is to not hold their hand from start to finish. You know, we can't do that. We just don't have enough people who know what we know. So we've created a lot of tools and resources that can give you the tools to make those judgments yourself. So just moving along, I'm a little bit behind time. So I just want to share with you how we can help first-time buyers and investors quickly. So this is off the back of Melvin's questions, which is quite timely. First thing we do is we help you create a strategy, because that strategy is based on how old you are, your income, your risk appetite, your equity or cash, your knowledge, and your willingness to learn. We've got some clients that do not want to learn how to do property. They just want us to tell them what to do. We've got other clients that want to do everything themselves, from find property to renovate property, to sell it themselves, to buy it themselves. They want to be the Kiwi DIYer. So we've got products for all of those people in between. We then send you off to some experts to make sure that you're looked after from an asset ownership perspective, from a tax perspective, from an accounting perspective. And the good news there is that stuff's a lot cheaper and easier than it used to be. The real challenge is making sure you've got the right professionals. So under step 2, we point you in the right direction, and we point you to good people right across New Zealand. So it doesn't matter where you are, we will give you the name and number and details of an advisor that we know is a property expert in that field, whether it's accounting or law or finance or structuring. The next step you will do is you'll go and secure finance. Unless you've got 500 million in the bank, most people typically buy a property with a 20 or 30 or 40% deposit, and they'll borrow the balance. So you need to go and get what's called assessed for finance. Now, the one thing, I spent 3 years as an investment lender. Mortgage brokers and bankers are not created equally. Some of them are complete half-wits. And I'm being harsh, but I'm being fair. I have dealt with some bankers and some mortgage brokers who literally get your information from you and they stick it down the scanner and they cross their fingers that someone will send them back a loan offer. So the way that a finance broker or banker presents your life financially can make or break a loan. And I cannot press enough how important it is in this area to get the right people. And we have experts in this field. So once you go to them and they look after you, you'll get a pre-approval. You'll get an amount that you can borrow or amount you can spend to buy a property, or 2 or 3. And at that point, we then work with our team and our extended team to make sure that you've got the right properties that fit with your strategy that you set at step 1, to make sensible financial decisions. We'll then massage that process for you so that it's not stressful and painful. And that's one of the good things about being a licensed real estate agency. And we will make sure it's smooth. And if you're buying a house that's not built yet, you will get regular updates about the house build. You'll get developer, and we facilitate this to the point that 6 weeks, 4 weeks, 3 weeks before settlement, we will make sure that everything's been put in place so that you have as little vacancy as possible if you're a landlord, or so that when you move into it as a first-time buyer, you can start planning your second house straight away. So that's when we don't leave you on your own. We start talking about property number 2, 3, or 4. So that's our property investment process. On our website, there is a stack of resources, and there's more coming. You can fill out the information for your property strategy session. You can fill out your information for a financial health check. If you're a paying member, you get access to our newest deals first. Now, you don't have to be a paying member, but there's going to be an offer at the end of this presentation to be one. And you can get access to our new projects 5 days before the Great Unwashed or the free members. We will give you access to our professional advisor network. That in itself is worth a lot of money, but you can't quantify it. The cost to you of going to a half-wit versus a proper professional is huge. I can't press enough. I deal with, often as a real estate agency acting for our clients, I have to deal with lawyers and financiers. And, you know, to be fair on them, it's probably 1 in 10, but that's enough. Maybe it's 2 in 10. Well, maybe 1 in 5 is a bit harsh, but it's 10 to 20% of professionals are completely incompetent. And, you know, if you're a great employment lawyer and then you decide that you want to be a property lawyer, that's scary. You know, people do that without the training. They do that without knowing what I'm not saying all of them do it, but a lot of them do. And I just get frustrated because I know a lot about property law, but I know nothing about matrimonial law. So, you know, I wouldn't start advising people about how to separate assets and at matrimonial level with kids and all the things involved. So, but a lot of these people do. So the access to the professional advisor network we've got is mission critical. You'll get invites to pre-release events. We had one last night in Christchurch, online events like this one. And you can subscribe to our regular property market updates. And I'd seriously recommend you do that because information is king. And when it comes to being informed, we know what's going on in the government circles, in the industry circles, up there with everybody. And it might be boring, it might be dry, reading about the district plan changes and the special housing area rules that they're changing. You know, there's a lot of things happening at the moment with Labor in the cockpit. Some of them are crazy, some of them are sensible, and we're keeping an eye on all of them. So the market update and the information that we'll send to you keeps you abreast of what's going on. We also send you can look at podcasts and videos on our website. We've got a Facebook members only group, which is for you to connect with other investors across the country or in your location. And we are doing 3 member-only 2-day retreats across the country a year, 3 of these a year. And that's so we can get you together. We'll be facilitating guest speakers, and we will be doing specific topic of the time, if it's tax changes, if it's investor rule changes, if it's bright line test changes. We will, in those retreats, there'll be a bit of fun, but there'll also be a bit of relatively intensive workshop time to really give people the current knowledge of what's going on in our property market. And I love that stuff. I love getting out there and pressing the flesh with our clients because, you know, I'm a property expert and I think it's one of my duties to share that knowledge with others. So those 2-day retreats are going to be really cool, and I'm looking forward to doing the first one of those that we'll be doing in a few months. This is just a snapshot from our website of some of these resources that you can access. And, this is stuff that helps your judgment. This is stuff that helps you become a safer, longer, low risk investor for the long term. So please spend time on our website. Please spend time in these resource areas. And the great thing about technology, in the old days, we had to do all this stuff in the room with you, whereas now we can actually do it on a website, on your phone, on your iPad. And, it's great. So let's just jump now. I'm just going to talk about our product. We've got a free product and you get all this stuff. Okay, we'll give you a property strategy. We will give you, you'll get wholesale property deals, but the paying members get them first. We will do a financial health check for you, telling you your borrowing ability and assessment. You get invited to these sorts of webinars, you get the regular market updates, and you get access to the podcasts and videos. We have a paying subscription, which gives you a few more things. You'll get an annual review of the property strategy. We will do your cash flows on your property, and whenever that changes, we'll do that for you for free or part of your membership. But the big one, I guess, sometimes, like the deal we've got at the moment, we've got 14 of them, but sometimes we'll only get 4, sometimes we'll only get 6. So one of the things we've done is create a sort of top or platinum membership to give people priority access to those deals, because if there's 10 people that want 4 deals, we can't really have a lottery. So paying members for our service get these deals earliest. And if I look at all of the value across that blue sheet, it's really access to those deals first, because they're going to come up quickly and they're going to go quickly. You also get some specialist property professionals that go and do a specific thing. Like if you want to do a subdivision, I had a lady last night at an event ask me, she's got a house in a really, really top suburb in Christchurch, and she thinks she can build 6 townhouses. I'm going to give her access to professionals that specialize in that area. They've said to me they only want real people of real customers, not tire kickers. This woman's serious, so she'll get access to those types of people. And the Facebook group is for paying members only, as well as the 3 times a year 2-day retreats. So that's a quick summary of what our membership is, but you can see it online. But the portfolio review, we'll look at your situation every year and sit down with you, and we'll talk you through it in terms of what would we do if we were you. We'll do all your cash flows. We'll do valuations on your properties so that we know what we're dealing with. The access, 5 days, the professionals, the Facebook group. These are real value things. These aren't things we're making up to look good. You're going to get our judgment on a much closer level if you decide to join our service. So what does all this cost? So we have a one-off fee to onboard people. We spend a lot of time getting you on board. We do all your cash flows. We get you into our system. That's about 70% of our true cost of onboarding you. So cost recovery to bring you on as a customer, and then we have a $98 a month ongoing monthly support. And as a special, because we've literally just launched this in the last few weeks, if you join today, you will get your first 12 months upfront, and no monthly. You pay your first year upfront, and there's no monthly fees for 12 months. So you get your first year monthly fees for free. So that's a saving of nearly $1,200, and that's pretty good. So that's the link on the screen there. Go to our website, and you will see that offer. So, and you'll only get it from, just let me check something. I don't know how you might have to get a special link. Okay, no, my team's just told me the link is our website /webinar. That will give you the link to that page. Okay, so that's the hard sales pitch tonight. It's a pretty simple service. And we don't sell it hard, because at the end of the day, if people want our help, we'll give it to them, but it does come with a small price. And in the scheme of property, that's not even one deal. It's about a fifth of a deal. So let's now jump to the Kiwi property market. And I'm going to rip through the stuff because I am a little bit behind. I'm just going to quickly see what this question is. And I'll come back to, someone's asked me a specific question about a specific property. So I don't know that project, Melvin, but I'll come back to you on it. So I will come back to you. So what have we got here? So one of the reasons that New Zealand property market is such a time to invest, and I say that broadly because there are some areas that are more dangerous than others, is that we've got historically low interest rates. We have a very low unemployment level. If I look at money in and money out, we have more investors coming into the market. We've got more owner occupiers coming into the market. So if you look at lending flows, it's been pretty damn good for the last couple of years. And from a borrowing of money perspective, what's going to happen, or one of the things that's happening at the moment, every time the government drop interest rates, a lot of money comes out of the banks and goes into other investments. And what that means is there's less money available. So the money gets harder to get. You've got to prove to the bank that you're worthy of the money more. But it's a positive indicator of the market because the money coming out of the bank in deposits often goes straight into real estate in a cash way. So and the big one, our long-term migration levels are hovering around that 50,000 people per annum. So as a country, we're growing by 50,000 human beings every year, and that's just people coming in. That's not babies. That's not New Zealand growth. That's just migration alone. So we are going to be full at some point into the future, but the good news is we've still got a bit of land to build on. If I break this down now regionally, Auckland's top left there, median price is flattening out. And that's a good thing because, you know, the average price in Auckland is not affordable to every Kiwi. It is our only true international city. But there's been a lot of concern around the Auckland market because it's just been growing so quickly over the last, 5 years. If they look at, and that's reflected in the bottom left side graph, which shows that the volume of sales has dipped. Now, if you look at that peak, it's about 2,600. If you look at it currently, it's about 2,000. So volumes are down, but they're not through the floor. So it's not a panic graph. It's volumes are dropping because prices are increasing. That's normal. If I look at the people buying in Auckland, first home buyers, 27%. That to me is the number. Multiple property owners with a mortgage has dropped. Okay. It's dropped over the last couple of years because it's becoming more and more unaffordable to buy investment property in Auckland. Now you still can, but you've got to be laser focused with where you buy. And, a lot of people have made a lot of money in Auckland over the last 10 years. But if you're buying an investment property there now, there's only certain places that you would buy. And, the first home buyers tipping or crossing that line last year is a sign that, you got to be careful in Auckland. And the average house price now is $1,040,000 or just under $1,040,000. Just come a bit south to the Waikato. Very safe location. Average house price is moderate at 580. Great growth over the last 10, 15 years. And if I look at it as a region of population growth, of long-term safety, Waikato is pretty safe. It's in what's called the Golden Triangle, which is your Hamilton, Auckland, Tauranga triangle. And there's some seriously attractive locations within that triangle, which we are lining stock up for at the moment. First home buyers take the prize, 29%. Who wouldn't? You can buy a beautiful new house in the Waikato for $500,000, where in Auckland, that will get you a second-hand absolute slum in some locations if you can find it. So I can see why people are moving to the Waikato from Auckland. You've got to have $1 million to buy a nice house in Auckland now. Or move into an apartment or a small townhouse. And interestingly enough, the people, as rental, because of the growth in Waikato, it's becoming a hard place to find the right kind of investment property. We still have it. We've got 3 projects actually that we're packaging up at the moment. But multiple people with mortgages are dropping. At their peak, it was 40% of the market in 2016, whereas now it's only 30% or 27%, sorry. So that just gives you a snapshot of the Waikato. Look at Wellington. Wellington's had its biggest growth spurt in the last 2 years, or 3 now. And one of the things that we had a lot of clients going into the Wellington market in about 2014. And we had a brilliant project. We were selling it for 450 to 480. And I said to the client, I said, "You're mad if you don't buy in this place. It's about to go up." And I was talking about Wellington in general. And I got it wrong by about 2 years. I was 2 years early. I predicted Wellington to grow in 2014, and it started to grow in 2016. And when I say grow, I'm talking significantly fast. So 16 to 19, Wellington has had seriously high growth. But if you look at it compared to Auckland at 700,000 average house price, it's still a long way behind the metropolis of Auckland. And it's the one thing Wellington's got over anywhere else in the country. Wellington City, Wellington CBD has the highest income per capita in the country. Wellington region is second to Auckland, but Wellington City is number 1. It's a lot of high paid professionals in that city, and that's what keeps the rents high. That's what keeps the investment stock high. And if you look at multiple property owners with a mortgage at 27% of the Wellington sale market, it's still a growth market. And 33% of the market is first home buyers. And they're all moving to apartments and townhouses or into houses well out of the city, because that's the only thing they can afford. So on average. So really, we've always looked at Wellington as your safe rental city. I don't know any landlords in Wellington that have had vacancy in the last 10 years. They always get properties rented the moment the tenant moves out. There's a shortage of rental property in the city, hence the growth of investment sales. And it's, multiple property owners with a mortgage. It's a very safe location, and it always has been. So if you look at Wellington, sale volumes pretty flat. That's good. And I'd expect that price to level off. It's not, I don't think Wellington's going to go to $1 million. It might, I could be wrong. I'm an optimist, but I just can't see it going much above 700,000. It's a pretty conservative city. People don't really have $5 to $10 million properties in Wellington, and incomes eventually cap out. So I think you'll see that number of 700,000 leveling off over the coming months, years. Otago, the poor old Highlanders who nearly got the wobbles in their quarterfinal in the Super 15 title. So Otago's had good solid growth over the last 5 years, but really it's the last 3 years. 3 years that it's spiked up to 450. It went from 300 flatlining since 2008 to 450 where it's at today. But if you look at that nationally, that's cheap. It's still cheap. And if you look at the first home buyers at 29% of the market, 26% is a mover. That's somebody upsizing or downsizing. It's just a change in market. That's quite a big chunk. Probably moving into new housing, I'd say, because the quality of the housing stock in Otago is pretty average. And you've got 24% who are multiple property owners with a mortgage. And I'd say a big chunk of that 24% are North Islanders, because your yields are much higher in a place like Dunedin. But I still say to them, don't buy secondhand, buy new. And your maintenance costs are going to be underestimated in your secondhand properties. Now let's move to Christchurch, the Garden City, where I have just moved. Average housing stock, 497. Like in the world of New Zealand, as a country where this is the second largest city, that is super cheap. And it's because of a tragic event in 2011 being the Christchurch earthquakes. And it's had what I call a land reset. The land, well, actually I'll start with the CBD. the four Abs in Christchurch define the CBD, and the amount of destruction that occurred from the 2011 earthquake, 80% of that location was destroyed by that earthquake or had to be pulled down because of that earthquake. 80%. Imagine if 80% of your suburb was just taken away. Imagine if 80% of the buildings in your town were just taken away. So what happened in Christchurch in the city, land values were reset. They were reclassified, they had to get fixed, and people were paying $400, $500, $600 a metre for CBD land. That same land's now climbed over $2,000 a metre. But even at $2,000 comparative to other cities around the country, that's cheap. Hence why the average house price is so low. And people haven't worked out yet that eventually all that land will sell. And once the CBD land sells, it kind of sets the precedent for the rest of the suburbs and the city. Now, there are certain suburbs which aren't 500 grand on average. Some of the suburbs are over $1 million. But if you look at it as a bulk location, I believe that flat line since 2016 is in for some rising. And it's because Christchurch is still a construction site that it's taken quite a while to happen. But I don't think it's going to be much longer, because the Justice Precinct completed last year or the year before, 1,200 new jobs. Well, not new jobs, but new jobs in the city, because those services were deployed in other locations. The convention centre, the sports facility, the stadium, 17 major infrastructure projects, bringing a big chunk of the 17,000 people that will live in the CBD when it's all complete. And currently there's only about 7,000 people living in the CBD. Add tourism, and you've got a whole lot of perfect storms going on. So Christchurch, in my opinion, is at the hottest time to buy, being at the start of a new cycle. And I don't say that because I've just moved here. I say that because I've been transacting here since 2013, 2014, and I've seen values flatline. And even though I just traded a property this week, I did that because I've just bought a new home down here. If I was going to be sensible, I would have waited another 2 or 3 or 4 years, but I'm a property trader, and you know, my debt levels as I get older drop in terms of my gearing. So I made a decision, but I know for a fact that the person that bought my property, they're going to do well out of it from the next couple of years, because I believe growth is coming. And I haven't got it wrong that often over the last 20 years. So New Zealand, if we look at supply and demand, population is a key driver of where people buy. Now, obviously Auckland, I said it before, it's the largest city in New Zealand, 38,700 people annual change in the last 12 months. But look at Christchurch, 7,000, it's number 2. And I think that number is just going to accelerate when more and more people realize how much of a beautiful place it is to live. And I'm from Christchurch, but I moved away from here nearly 30 years ago. And now that I'm back, I find it an unbelievably easy place to live. And I've been in the country for 15 years, so it's so cool being back in a city. I mean, before that we were in Wellington, and Wellington's a great city too. But I'm just loving being back here and seeing the architecture and the infrastructure spend that's going on. We've got everything in Christchurch is brand new, and it's fantastic. So, you know, and if you look at the new building consents, obviously the largest number is going to be in Auckland. That's just common sense. But the big key in this graph is that building consents have dropped. What that means is that 50,000 people a year coming into the country, natural population growth, our surplus stock is getting filled up. Builders and developers are selling apartments and houses. Tenants are renting them. So at some point, we're going to have demand exceeding supply. We've got natural growth. We've got declining building consents equals demand is climbing over supply. And that doesn't happen all the time. If I look at affordability, Christchurch is the red line there that's been circled. It's second to Dunedin. Now, Dunedin, no disrespect to it, is not Christchurch. Christchurch has the only other 24-hour airport in New Zealand. It's a direct flight hub into Asia now. 7,000 people work at Christchurch Airport. You know, it's a major city, and I believe at some point it's going to be the sort of the mecca of urban planning and urban design based on the quality of what's going on in the infrastructure spend, the private sector spend, and even the residential spend. People, they call it the Garden City for a reason. People are really house proud in Christchurch, and yeah, we've been really impressed as home purchasers with the choice we've had. So average dwelling values in Christchurch have been flatlined for a long time, and I just don't think that's sustainable. It has to start pointing up, whereas all those other graphs are pointing up, and they have been for some time. So Christchurch is in for uplift, in my opinion. If I look at who's buying, the first-time buyer market is the biggest percentage at the moment, and it's because the houses are so damn cheap here. But multiple people with mortgages, you know, they're still 22% of the market. They've dropped off a bit, and as have the movers, because it's just getting hard to borrow money here. Plus, you've got an added complexity of land, the new land rules here, TC 1, 2, and 3. You know, buying secondhand property in Christchurch is actually quite difficult at the moment because of insurance, but it can still be done. So I think that's probably had an impact. But if you're buying a rental property here or a first time that's new, it's very, very easy. Banks leaned on them. They like them. The land's been fixed. It's the market. And understandably 28% of all sales. So if I look at that across the board, you know, 450 in Dunedin, 497 in Christchurch, big jump to Wellington at 700, Tauranga 700 odd, Hamilton nearly 600. Christchurch is disproportionate. It doesn't make sense. That's crazy. How could Hamilton be worth more on average than Christchurch? Doesn't make sense. So, you know, I just think it's just pointing at price rises. So that then leads me into, and I've got 9 minutes, and I really want to be finished by 9 o'clock and do some questions. I've got 9 minutes to quickly talk about this great project that we've just launched. Now, we're going to be launching multiple projects across the country over the coming weeks and months. And on average, we'll probably release 1 property a month, maybe 1.5 properties a month, 2 properties every, 3 properties every couple of months. So it's not a volume thing for us. We pick our developers very carefully. We pick our builders carefully, but we pick our locations the most carefully. So Karamu is in Riccarton, which is Riccarton Park, is in the suburb of Russley. And we have a heap of information online about this project, and I'm not going to take you through them. I'm not going to take you through them all because you can do that after this presentation. You can do it tomorrow. You can do it on the weekend. You can do it when you're on the loo. It's a really, really deep information book that we've got here on the project, the financials, the location, with market analysis, how it works with the property factory, some research. But if I snap through it, this is an aerial photograph of Christchurch and surrounding suburbs to the north and northwest. So you've got Edgware just above the CBD. You can see the 4 Abs. That's why Christchurch is called, you know, the city of the Garden City. That's Hagley Park, the 4 Abs. And the red ring on the left is Karamu in Russley. And just above it's the airport. And just to the right is Canterbury University. And very solid suburbs of Avonhead, Ilam, Upper Riccarton, and Hornby. Now, where this is rare is that it's off the back of a race course, because typically in a location like this, most of the housing stock is second-hand. So this is a really rare situation where the developer and the land developer is, in my opinion, one of the best in the South Island, and that's Ngāi Tahu, one of the Māori tribes who build subdivisions brilliantly. They did Wigram Skies, they did Preston's on the eastern side of Christchurch. Those subdivisions are finished and they are stunning, and Ngāi Tahu build land brilliantly. So the land, this subdivision was first created by Ngāi Tahu, and we have worked with a very well good reputation builder in Christchurch. I think they've been around for 40 years, and they've put together some really attractive properties that are perfect for first home buyers. They're perfect for investors, and they're smack bang in the middle of what I deem a golden suburb. I was in that suburb yesterday. refereeing the girls that I coach playing soccer. It took about 8 minutes to get from the CBD to the soccer field. So this is seriously close to everything. For me to bike from that racecourse to the airport would take me about 7 or 8 minutes max. To drive, it would take about 5 or 6. And it's not, biking's quicker than driving. So everything in that map is so close to everyone, everything else. I got it wrong. It was 6,000 people employed at Christchurch Airport. 7 minutes by car, 16 minutes by cycle. I can actually do it in about half that time, but I'm a cyclist and I ride hard. And I have timed it. But if you're just puffing along on your bike, David's worked out that it takes about 16 minutes, but it's not that far. It's also adjacent to what we call the inland port of Rolleston. The Carter family were one of the greatest things that happened to Christchurch. They invested $500 million in an inland port in Rolleston. So ships come into Littleton, they put freight on a train, and that train or truck drives to Rolleston, which is an inland port. Hamilton's got an inland port. Christchurch has got an inland port. 16, probably, actually not 16 minutes, it's probably about 10 minutes away from this location. It's also got a lot of occupants who typically rent 1 to 2 people. So, and there's a shortage of rentals at the moment, and listings that meet rental type standard because of it's such a developed suburb. So this is stage 1 of a 5-stage development. And with Christchurch's population forecast to be growing by 13,500 in the next 5 years, it's statistically speaking, it's only going to get better if you're a landlord in this location. This is just a quick master plan showing the subdivision next to the race course. There's a lot of infrastructure going into this area. There's a proposed preschool. I think that's actually been confirmed now. There's a playground. There's a whole lot of things which are very, very key to what I deem in a great subdivision as opposed just an average subdivision. Not all subdivisions are created equally, but when you're getting Ngāi Tahu doing something, they do it properly. We've got partners in the south of the South Island who do subdivisions properly. And again, that comes back down to the developer and their background and their reputation. This developer is one of the best in the South Island. So you can look at that scheme plan online. So here are the quick high-level numbers. So we've got a number of 2 and 3 bedroom townhouses for sale. These are off the plan. They haven't been built yet. The builder is starting in the coming weeks, and it's at an early stage. So we've managed to negotiate a healthy discount from the developer between $17,000 and $32,000 per property. The $17,000 discount is on the 2 bedrooms, or mainly on the 2 bedrooms, and the 32s on the 3 bedrooms. So that's valuations of $545 to $560 on prices of $518 to $543. So it's under that average in Christchurch in a top location. And this is the discount off the plan. This is excluding market growth that you'll get whilst the place is being built and after you own it. So we've just released this, expected to be completed in March of next year. It's a relatively short build. It's a decent sized building company. It's not Bob the Builder and a couple of mates. There are 16 available. I think we had some reserved today. 9-month build. So from a strategy point of view, you're getting a nice gain at the beginning, and then you're going to get capital growth over time. It's also a turnkey project. Those deals that I showed you in Queenstown and Wanaka, all of those people, including myself, had to enter into what's called a construction loan, and far more involvement, far more hassle from the buyer. With these, you put 10% of the purchase price down when you go unconditional, and you pay the balance on settlement in 9 months' time. It's that simple. These are some of the local amenities. Top left, is showing the restaurants. So that's over a dozen restaurants. And that top right is showing the cafes. Bottom right is showing the different schools in the area. And as you can see, there's a lot of schools within Kui of this location, from primary to secondary. And then to the left, you can see all the bus stops. So tenants look for these things. They want to be close to infrastructure, amenities. They want to be able to walk places. They want to be able to have ease of shopping and schools and your entertainment options as a family or as a couple. And this location has it all because it's developed. It's not a startup location. Like North Lake and Wanaka was. They had to build all that stuff. Here, it's already there. So tenants are moving into all of this stuff when it's already happening. So Russley's been outperforming other locations in Christchurch over the last 5 years, which is good. So if you look at the comparative median house price for 2 bedrooms and 3 bedrooms, or sale price, it has been outperforming the Christchurch average, which is nice. So looking back, it should continue that way. If not, I mean, the one thing with Christchurch, the infrastructure spend on the roads has been such that you can get around the city better now by driving on the peripheral roads. And because this is near the airport, you can link onto one of those, which is the western, I call it the western corridor of Christchurch. And if you're going north, the distance from Christchurch Airport to Wood End, which is, on the way to Kaikoura, is 6 minutes to 14 minutes, depending on the time of the day. So, and this is about 5 minutes of that from the airport, depending on the time of the day, 3 to 7 minutes, depending on traffic. So not only has it been outperforming Christchurch average in the past, but when all these roads, because they haven't finished building all these ring roads in Christchurch, but when they all get finished, zipping around the city will be so quick. And if you look at this graph that I had before, that great big line that shows International Antarctic Centre of Christchurch Airport, that's one of those ring roads. And it is one of the ways you get around the city quickly. So I can't reiterate enough how much faster it is to drive those ring roads than it is driving the internal roads. And that has an impact on your ability to get around. So this is just a snapshot of, I said to the team, I said, what does something like this cost in Auckland? So it's a bit of a tongue-in-cheek thing, but this is real. But a similar sized property in Auckland is 1.45 million, 2 bedroom, 2 bathroom. And in Karamu, the same product's 518, but it's a bit of a, I mean, it's not that you can't really compare Auckland to Christchurch, but in the scheme of capital growth, Auckland's had awesome growth for the last 10 years. This place has been flat. I'm not saying it's going to go to $1 million, but at some point this product lifts in price. So we've done 10-year cash flows on these properties, on the 2s and the 3s, and these are our assumptions. We always work on the basis that someone's borrowing 100%. So your cash flow is going to be higher if you're putting cash in. We assume an average of 2,000 for the 2 bedrooms, 2,500 for the 3 bedrooms on rates. And we work on 2 weeks vacancy per annum, 5% capital growth. That's actually below the New Zealand long-term average. $1,200 to $1,500 for insurance, $400 a year on maintenance. Remember, this is a new property, so that's you're not going to have to, well, you shouldn't have to spend anything on maintenance, and an 8% property management fee. So if you have your own assumptions, it's going to change the cash flow, but these are the assumptions that we've made. I'm not going to talk you through the cash flow, except to say one thing. New Zealand has changed the way tax is treated when it comes to rental property. Okay, so the interest on your mortgage is tax deductible. Your property manager's costs are tax deductible. Your insurance is tax deductible. Okay, so that means you get a tax benefit from those things. The cash flow here is saying that the pre-tax cash flow per annum is $4,480. But once we factor in the tax benefit from the depreciation on the chattels and fit out, so you can't depreciate the building, but you can depreciate chattel and fit out. That depreciation, the tax deduction on the interest, all of those things gives you tax benefit for, sorry, I haven't put that on the screen. Property expenses of 5,300. Your depreciation alone is 13,000. So we haven't shown the whole cash flow, but when you actually log into the property, you'll get the whole thing. But year one after tax is positive by $780. And once you get your tax credit carried forward, it's $5,000. So it is costing you $5,000 a year to pay all those expenses. So there's $17,000 worth of tax losses, which means you're going to carry a tax credit forward of $5,000. Now, what that means in real money, when this property starts paying itself off and it's profitable to the point that you are paying tax on it, you'll end up with a whole bunch of tax credits. And what that means is, if you look at this cash flow, in year 5, it's just about break even. And at that point, that means you've used all your tax credits up. So basically, for the first 5 years, it washes its own face. After that, it's actually paying tax. So that's good. If you're paying tax, you're making profit. So this property almost pays itself off if you incorporate the tax credits that you're getting from year 1. Well, it does if on 100% interest with these assumptions. So that's a pretty good deal on a brand new property. It's quite rare that can happen. Now, this is working on rent of $440 a week in year 1. And I believe that rents in Christchurch are on the rise. That's pretty low for a brand new house, I think, and that's the 2-bedroom. So, but that's the market rent. That's the average that we've got from property managers, but it just feels low by national standards. 3 bedrooms, $535 a week, similar numbers. After tax in year 1, it's $3,000 tax credit going forward, $4,000 for that carrying on. So, from a cash flow and a tax perspective, it's pretty neutral. And that means that you're not pulling out $10,000 a year from this property, but you've got a brand new property that's pretty much paying itself off over the 10 years. Hence why we said right at the beginning, your strategy should be to let the rent pay the property off and then live off the rental over after 10, 15 years. And this property is an example of a property that can do that for you. In year 10, your pre-tax cash flow from this property is $5,000. But what this isn't showing, from year 10 to 15, that debt gets paid on. And remember, we borrowed 100% on this. But those interest payments will get lower and lower and lower as you pay off the debt. So, a number of different hypotheses could happen here, but more than likely, if you pay it off in, 15 to 20 years, you're then getting 20, 25 grand off that property that you're living off. So this is a quick schedule. This is on our website, so let's not go through it. But on average, the 2 bedrooms are 128, 29 meters. The 3 bedrooms are 150. So these aren't shoeboxes. These are decent sized houses. We've just done a quick summary of the yields here. They range between 4.3 up to 5.2. As you can see here, there's a couple of sold. We've got a couple of people putting expressions of interest down on these based on last night's event. The discounts range from, in dollar terms, 17, or there's one there for 10,000. The lowest is 10,000, and that's the sold one. But the other, that was obviously sold through a real estate agent. Just the other thing I haven't mentioned, these discounts, you can go on Trade Me and you'll see these properties for sale at full retail. Okay, so we have got a genuine discount from the developer. It's only for our clients. So that cash discount or percentage discount is a real dollar or percentage based on what the retail market are selling these properties for. So that's not to be sneezed at. And in the world of property, any equity you gain on entry is as powerful as equity you're gaining over time. So if you want to take this property further, you need to log in as a member, review price list. Our team can help you with the selection, so make a call and you'll probably get Grant or Dennis. Submit your expression of interest form. We need you to fill that out. We will then need to what's called AMLU, and which is anti-money laundering you, making sure that you are not a money launderer. And basically that means we need to see that you're a real life human being, and we'll ask you for a copy of one of your utility bills, your passport or driver's license copy. So our team will do all that. We will then issue you with a sale and purchase agreement. You'll go through a due diligence process. So you've got a safe conditional period in that contract that you get to do your homework on, get your lawyer and all their experts. Once you're ready to buy, you will pay a 10% deposit and pay the balance in March of next year or thereabouts when it's finished. First home buyers. If I was a first home buyer, I just wouldn't even think about this. I'd just buy it. Because more than likely you're only going to live in it for 2 years. And after that point, you'll probably rent it out as a rental property. But when you buy it as a home, if you're a first home buyer, you can actually borrow up to 95% with selected mortgage brokers. Your rent, or not your rent, but we've worked it out at 4% interest as a first home buyer, it's cheaper than renting it. And with KiwiSaver, with first home buyer grants, you could get into Karamu for as little as less than $6,000 cash on top of the different grants and benefits you can get. So that just seems crazy. But the great thing is we have a really, really favorable lending rules and subsidies for first home buyers. We need to get more people into property, and this isn't going to last. I mean, that offer there just looks crazy, but that's the government, that's the banks, that's the KiwiSaver fund, allowing you access to that money that you've been putting in there for years to pay your deposit. So, you know, you can get up to 10,000 on new properties or 20,000 in a couple. That's real money you can only get once. If you buy a house without going for that, you can't get it back in the future. You can only get it once. So we've got a whole first home buyer section on our website. Make sure you click on that if you're a first home buyer and read up. It is technically free money because you can't get it after your first home if you haven't applied for it already. So become a member to access these wholesale opportunities. At worst, become a free member. You can save nearly $1,200 tonight if you become a paying member, and I'll beat my hat if anybody goes a year with us and doesn't get value. So that's us. You need to click on that link, or you can't click on the link. You need to type that link into your browser. If you lose it, just ring one of the team and we'll email us and we'll send you the link. So please join, because you get a lot of good information. You get a lot of free resources, and you can still access our amazing team to help you secure safe and long-term low-risk properties. So have a good evening, and I will see you at the next one of these events. Thank you very much.